On April 9, 2025, our RBI Governor, Mr. Sanjay Malhotra, decreased the repo rate from 6.25% to 6%. After the tariffs imposed on the global trade market by Trump, what is this now? How does this repo rate affect the Indian market? And most importantly, what does it mean for the stock market? If you love financial knowledge as much as we love creating them, then make sure to hit the like button and subscribe to our YouTube channel to never miss out on any updates from us. Say you require a loan of rupees 1 lakh. So you go over to a bank, but the bank has a shortage of around 50,000. But after some time, you get your loan approved and receive the money. But how did the bank fetch the remaining amount? Did the bank employees all contribute to sum up to your required amount? Well, no. When a commercial bank needs funds, it borrows from the Reserve Bank of India. In return, the bank provides government securities or bonds as collateral. Once the borrowed amount is repaid, the bank buys back these securities. This process is called as the repurchase agreement, and the interest rate the bank pays to the RBI for this borrowed money is known as the repo rate. Here's an interesting fact. Repo rate plays a key role in controlling inflation and maintaining economic stability. Let's find out how. Say, a commercial bank such as SBI decides to borrow rupees 100 crore from the RBI. The repo rate is kept at 6.5 per annum. The bank and the RBI agree that the bank will repay the amount after 7 days. The bank gives government securities worth rupees 100 crore to the RBI as collateral, and the RBI gives the bank rupees 100 crore in cash. After 7 days, the bank buys back those securities by paying an additional of interest rate or the repo rate. Hence, the RBI receives an amount of rupees 101.2466 crore. But this was until the 9th of April. Now, with the decrease in repo rate, the amount comes down to rupees 101.1507 crore, saving almost 9.59 lakh. Now that's a gain for the banks. And due to this, banks may lower loan rates, encouraging borrowing and spending funds, which can ultimately boost the economy, but may cause inflation. But that's a completely different story. Let's talk about why you clicked on this video. What does it mean for the stock market? Due to the recent increase in tariffs in the global market, international trade flows have had a major impact. Hence, the repo rate was brought down to 6% to encouraging lending and investments, ultimately strengthening our economy. Stock markets and interest rates have a negative correlation, meaning when interest rate increases, stock market prices recede, and when interest rates go down, stocks do well. Lower interest rates boost demand. People borrow and buy more, resulting in companies performing well, which is reflected in the stock market prices. So, does this mean you as a customer can now avail loans at lower interest rates? Short answer, yes, but not instantly. Now that is because it all depends on other factors too, like are people feeling confident enough to spend money even with concerns about job security and the pace of salary growth? Are businesses ready to borrow and invest? Are global trade and markets stable? Well, at the end, whether the market crashes, leads to stronger growth, or just stays the same, only time will tell. Although one thing's for sure, all eyes will be on how this plays out across loans, spending, and the market in the upcoming days. How do you think the market will turn out to be? Make sure to let us know in the comment section below.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.